is Torsten Slok, the senior economist at Deutsche Bank. And Torsten, I know that you see payrolls down 65,000.
That's true. The big unknown factor here is really what's happening to state and local governments. They have been in significant trouble through most of the crisis. They're gradually coming back here, but it's something that's very difficult to forecast exactly how much we're going to see.
But then how do you, because to us it looks quite bullish to say a decline of 65,000. How do you come up with that, though? Is it the private sector that's making it up, or what?
Yeah, I mean, the private sector is really the 800-pound gorilla here, that we're not seeing any significant job growth. Remember, just to have a steady job growth, we need 100,000. So in the private sector, we're not really seeing that at all. So and we anticipate.
Then what do you forecast then for this month, for this past month?
40,000.
40,000. Okay,
plus.
So you're pretty much right on line then.
We are positive on the private sector, but it's very, very slow because we had, of course, hoped that the recovery would be stronger, but unfortunately, it's still a slow grind here.
Now, Paul McCauley, who we're going to have on in the next hour from PIMCO, he says, look, this is going to have profound implications for the Fed. This one report, what we see. Is he overstating it?
No, I think he's right, because the whole issue here is that where are you relative to growth and where are you relative to the trend line of 100,000? If the trend line is 100,000 and you're below, then you have the problem that the unemployment rate will continue to grind upwards here. And the issue is that with the growth rate, it's the same thing. If growth is below 2%, you'll see the unemployment rate go up. If growth is above, you see the unemployment rate go down. But the unemployment rate picking up here, which we're also expecting, is just putting the Fed in a very difficult situation.
Right, and I think what he's alluding to is that, or what he's basically implying, is that this month's report is going to be impactful for the Fed, for the Fed meeting later this month, and whether or not they're going to go further with quantitative easing.
Exactly, because for them, the big question for the market is, how desperate are they? I mean, do they feel that we need to wait a little bit longer and hope that things organically will come up on their own? Or do we really need to say, well, now things are moving definitely in the wrong direction with the unemployment rate going up, then we need to basically pull out all the stops and do even more quantitative easing?
So if we get a bad report,
I think there is a good chance here that we could see some more quantitative easing in the coming months.
Okay, coming months, as soon as?
Maybe the next meeting or maybe the meeting after.
Okay, and if it's an okay report, let's just say it's lukewarm, it basically doesn't provide much more direction, what does the Fed do?
Well, I think then it would be a tough call, but for them it's also the issue that if they pull this rabbit out of the hat now,
right,
then they are sort of running really out of bullets. So that's why they have to be careful also with expectations in markets. What is the market thinking? And at some point the big risk is that the market ends up saying, well, you don't really have things under control. And that's why the risk here is that they have to be very careful in managing expectations in the market and where the market is thinking.
Right, it's almost as if that is one of their last bullets, right? So once they use that up, then that's it. That really is it.
Yeah, because the wow factor that we had when they did it the first time, we all said, wow, they also have that instrument. They don't have that wow factor now, and therefore the announcement effect originally was really the key driver of why it had such a big impact. But the announcement effect may not have that same significant impact this time around because they have already done it before.
But Torsten, if they don't do anything, okay, even if we get an okay number and they still don't do anything, does that mean that the stock markets continue to go lower?
Well, the different issue, I mean, for them, it's also a matter of, they, of course, look at where mortgage rates are and say, this is incredibly important for the main part of the...
You're saying that they're not paying attention as much to the stock market.
I think they are,
well,
but I think that the main number one problem still continues to be the housing market and the fundamental underlying issues and generating all the equilibriums and going through all the problems we had in the housing market.
Right, but it's not about rates. It's about demand.
True.
That's what we've been hearing about. That is now coming to light, is that it's really about demand. It's not about, I mean, the banks do have the money, they're just not willing to lend right now. And
you could generate demand by having more stimulus from the fiscal side, but they have also run out of bullets there, so there's a big issue here that the policy is not particularly potent at the moment.